All right, everyone, let's chat about RSI or replace any overbought, oversold oscillator you want here. But I just want to chat a little bit about this because of some stuff that I've been seeing people talk about in the market. And I just want to do a little bit of debunking of those things as I normally do with math, as kind of the resident math nerd out there. As always, if you want to take your trading to a more quantitative, more systematic level, come on over up there, StatsEdgeTrading.com. Also, we have a free email list and we've got some free courses that I've launched for you guys. You can see right here. So if you click on the free trading plan course, or if you're very new, a free intro to trading course, you just put in your email completely for free there. You can sign up for the free newsletter. I email you out every time there's a new video or something cool that I want you guys to see. But I want to talk here about RSI. And the reason for it is because you can see down here on the SPY, everyone's saying, "Oh, well, listen, you buy the SPY when it gets overbought, and then you sell it when it gets oversold, and that's great. That's an amazing way to make money in the market." And that's not at all true. It's not true in any way. So we need to talk a little bit more about it because that is what we call recency bias, which is the idea that whatever happened the most recently is the thing that is probably going to happen continuously and into the future. And it's just, again, not the way it works. We want to test things back with a lot of data and a lot of statistics. So I not only did the SP 500, I did everything, every stock in the market, right? This is something that, we got the capabilities to do here where I can go back and test any kind of theory. So if there's anything you want me to test that you hear everyone say all the time and you want to see if there's any validity to it at all, put that in the comments below and I'll make a future video about it. But yeah, so the idea is, when the RSI gets oversold, or any oscillator, they all work the same. You buy, and when it gets overbought, you sell. Well, right, if we go right here, this is what happens if you bought stocks every time they came oversold and then you sold them when they get overbought. Ignore these massive numbers here because to test every stock in the universe, I gave the back tester like billions of dollars worth of buying power. So that's why these numbers are insane. But what we're doing is we're essentially just saying, okay, we're going to buy a stock when it gets under the 30 on the RSI, and then we're going to sell it when it gets back over 70. And the other way, we're going to do it completely the other side, where we're going to buy it when it gets overbought. We're going to buy every stock that it hits over 30, and we are going to hold it, or over 70, and we are going to hold it until it gets under 30. And that's what we're going to do every single time with both these. You can see, well, first of all, one, if we go to the equity curve here, this green line is buying when it gets oversold. You can see not only does it go bankrupt a handful of times, but you're getting huge drawdowns here. You're getting, 70, 80% drawdowns happening all the time. And although the red line doesn't look nearly as sexy, you're grinding higher. You're buying things as they move higher over time, right? So if I get out of the way, right, here's the two times that it went bankrupt in this 20-year back test, and the red line just kind of continues throughout. So the main thing to look at is, again, right here, where we're saying, okay, there's at least a strategy here. You make 4% year over year, and you only lose 20% in a max drawdown if you do the complete opposite of what everyone in the textbooks say, and you just buy stocks they hit overbought. There's no other conditions than that, right? Stock hits overbought, we buy it. Hits oversold, we sell it. Vice versa. And the cool thing, it's an interesting thing about this, is look at the win rate. It's another new thing another thing that new traders struggle with is percentage win rate. I want to be right very often. Well, you are right here. You're right 61 or 62% of the time right here on the win rate of going bankrupt and losing 70, 80% of your account over and over and over again. You're right very often. However, just takes one giant blowout and you're done. Even your average win is beating your average losers. But what happens is you're buying a bunch of stocks that end up going bankrupt over time. Now let's do the opposite, where we have 47% win rate, our average winners, three times our average losers. So that's a good one as well. But we only have a 47% win rate. We are right less than half of the time, but this strategy slowly and over time ends up making money. So don't just take this and think about, hey, RSI is useless or I'm not going to use it anymore. I have strategies that buy oversold RSIs with a whole bunch of other caveats in place. But look at this and say, okay, well, what else potentially are we doing something in which we have just kind of taken the conventional thinking, things you've heard from gurus online or read in books or whatever, and have just regurgitated verbatim with no testing or anything like that. And to see, maybe there's some instances in which if you go back and you actually run some testing, and comment down below if you want me to look at something, that you can actually figure out if there's an edge in what you're doing or not. Again, not to say there is no edge in RSI ever. It's to say the edge in RSI might be a little bit less than you're normally thinking it is, and it might be reversed. So what do these oscillators mean? Essentially, when something is becoming overbought, it means that there's a huge momentum thrust and there's an overwhelming demand for that security. Is that bearish? Maybe in the short term, right? Maybe it's one of those you don't want to buy overbought stocks, right? That's another test that we could do. What happens if I am buying stocks that are breaking out, but I ignore everything that's overbought? Does that make it better? Does it make it worse? I don't know. That's what we do over at StatsEdgeTrading. That's what I try to do myself with my own trading. I have no preconceived notions about anything. My answer to every time I have a question to myself is, let's test it and find out. So for more of this content, again, make sure you're following, make sure you're sharing around. Let's just start going through indicators and debunking them. So again, let me know what it is you want me to look at next, and maybe we'll do that next week. I will talk to you guys soon.